Welcome to Changing World, New Opportunities. This podcast is brought to you by the DC Investment Forum and hosted by me, Louise, and my co-host, Dave Whitehair.
This season, we're talking to the UK's leading master trusts. Millions of members and people in the UK now rely on master trusts for the future of their retirement finances. And we were interested to know how master trusts are investing and what the future holds.
In an uncertain world, how are they managing risk? And what's next on their agendas?
The DCIF's mission as a whole is to shine a spotlight on topical DC investment issues. And you can learn more about our research, follow us on LinkedIn, and subscribe to the show at dcif.co.uk.
Hello and welcome to an episode of Changing World, New Opportunities, the DCIF's podcast. I'm here with Dave Whitehair, my co-host, and Dan Mikulskis. Hi Dan, nice to have you here.
Hi Louise, hi Dave, delighted to be here. Thanks so much for having me. Really looking forward to the conversation.
Oh, well, for anyone who doesn't know you, and I'm sure most people will, you are the Chief Investment Officer of People's Partnership, and you took up that role, I think, in September 2023?
Yeah, that's right, 2 years ago.
Bit of LinkedIn stalking. And you today run over 32 billion worth of assets. Is that the latest number still?
A little bit more than that. Today's numbers, yeah, but markets are up, so yeah, the numbers do get higher.
Wow. And before your current role, of course, you were a partner at LCP and you hosted a very popular podcast, which we were just talking about before we went live. So we're both feeling slightly nervous. Big shoes to fill, but very nice to have you here. Podcast royalty.
Yeah, really looking forward to this conversation. Obviously, in the relatively short time you've been at People's Pension, you're publicly available, lots of change, building out a team, lots of change in the investment strategy. So yeah, really looking forward to having a conversation about some of that.
So Dan, tell us a bit about your career path. I've just done a slightly potted history, but tell us anything else that you think the listeners should know about you and your role today.
Yeah, well, I joined the pensions investment space 22 years ago. For most of that time, I've been a consultant, worked three different consulting firms. I started my career at Mercer, spent a lot of time in the middle there at Reddington, and then latterly at LCP. I did have a short period of time where I moved to Sydney and worked more in investment banking and funds management for sort of 3-4 years there, just after the great financial crisis, which is interesting time in itself, but mainly I think you can think of me as a sort of a former consultant, maybe a reformed consultant. You might go as far as to say that. But I studied as an actuary, so did my actuarial exams at Mercer, and so yeah, for the bulk of my career, I've been advising pension schemes, asset owners on all the good stuff that you'll know: manager selection, asset allocation, strategy choices, and over that period of time, worked with a huge range of asset owners, worked with a number of CIOs on bigger schemes. And of course, you do that for long enough and you start to sort of daydream about what it might be like to do that yourself. And it was fantastic, good fortune that I got the chance to sort of put some of that into practice. I feel incredibly privileged to have that role and to be able to put some of those ideas into place over the last couple of years.
So before we dive into some of that detail, can you just give us a general overview of the investment strategy that you've adopted at People's Pension?
Yeah, I mean, there's probably two things to think about. One is the investment strategy, but the other one, sort of slightly higher level than that, is more the asset ownership model itself. Mm-hmm. I'm happy to touch on both areas, but maybe if I start with the asset ownership model, because that's where I felt there was a need to distinctly move it on from where we were. I guess, sort of bit of background history, I think most DC schemes in the UK started with a pretty basic approach to asset ownership. Mm-hmm. And I don't say that in a sort of a critical or negative way. That was absolutely necessary and appropriate at the time. Yeah. And what that meant was they pretty much outsourced all the asset management, often to a single provider, all passive, and the kind of internal investment staff might have been quite small. Mm-hmm. Maybe a CIO, maybe not even that, maybe sort of 1 or 2 people overseeing it. You get slightly different approaches depending on whether you're talking about someone who had a captive asset manager as well as part of their group, or whether it was fully independent. But that's broadly where people start out. It's also where the Australian super fund started out. So perfectly reasonable place to start from. There comes a time when I think you need to move that on a little bit. And I think it's in members' interests to move that model on. And I certainly felt that when I joined People's Partnership, we were at that point. We were 20 billion at that point. We could certainly support a much larger specialist investment team. Mm-hmm. And so that was what we've been trying to build over the last 2 years. So we're now at sort of 25 in the investment team. And that's 25 people, full-time, dedicated to one client, effectively People's Pension. Yeah. So 25 of us coming in every day thinking basically, how can we make people's pension better? So 25 is not a huge number in the grand scheme of things, But compared to the DC market, to be fully focused on the one client, it is quite a lot. So as part of that, we've got asset class specialists. We've got an equities team. We've got a fixed income team. We've got a real assets team. We've got a dedicated investment operations team. So we brought a lot of that in-house. We've got seg mandates. Love to talk about that later, maybe. A dedicated responsible investing team. So trying to move that on to the next stage model, which is still outsourced in terms of the investment management, but more managers than just one. And a more sort of sophisticated internal team that can really run that as a sort of strong asset owner, asset allocator, rather than it just sort of being an oversight role of an entirely outsourced thing. So I say that, I mean, I can probably go on for far too long about asset ownership models. I think it's a bit underappreciated, basically, particularly in DC. And I think that's kind of really important foundation for everything else.
So what does it mean to you to be an asset owner? And I suppose especially in relation to people's partnership, which I guess has quite a different model in the master trust world to some of the others, right? In the sense that it was where it started from.
It does, and thank you for saying that, because I think that is underappreciated as well, right? So people's partnership is the provider of the people's pension. And that is a tongue twister if ever I heard one. I mean, I don't know how we've managed to create a tongue twister like that. But anyway, People's Partnership is a profit for member organization. It grew up out of the construction industry. It was founded in the 1940s. And for most of its existence, it was sort of a federated trade union type supported entity that provided financial products to the construction industry on a profit for member basis. That is the sort of that is the genesis of most of the Australian super funds, because they're all industry based, right? So the CBUS is the construction industry equivalent in Australia, but they all have one for each kind of major industry. There's obviously been a bit of consolidation there, as you'll know, but that's quite a common sort of genesis of asset owners in Australia, not so much in the UK, actually. In the UK, auto-enrollment was grafted on a far more of a retail commercial type landscape. Obviously, there's Nest, which is sort of government, also kind of profit for member, one or two others. But yes, we do think that profit for member perspective is important. And to come back to your question of what it means to be an asset owner, I think the Thinking Ahead Institute done a lot of work on this, but I think you can boil their work down to three things. One is you work on behalf of members, putting them first. Two is that you have the fiduciary mandate to do things. And three, this sense of a sort of a societal license to operate. And I think being profit for member is actually essential to those first and third ones. It's a bit of a controversial view, maybe, given a large part of the landscape is not profit for member. But I think that ensures that you are putting members first, and it gives you that stronger social sort of license to operate as kind of an asset owner. So yeah, thanks for the question, because I think it's underappreciated. We would obviously love to have that be more fully appreciated by the industry, but clearly we need to do a better job as well of telling that story and helping people understand why profit for member is such an important model.
So as a result of the new framework that you've put in place at People's, how was that translated into changes in the investment strategy at high level?
Yes. So, let's talk investments. Exactly. So where to start? We, of course, we look after money for folks at the whole different stages of their career and retirement. So we, of course, run a range of investment strategies. But really, you can boil that down to two main strategies that we run. One would be a growth strategy for folks earlier in their career, and one pre-retirement strategy that we're getting folks into as they're approaching retirement. So that first one really focused on growth, particularly growth in real terms. And the second one focused on a more balanced kind of risk managed kind of strategy that's not going to deliver large negative surprises just before retirement sort of thing. So we're thinking about those two allocations really quite a lot. But some of the changes we've made have been, so one of the first changes we made was going into segregated mandates for a large part of that allocation in listed markets. I think they're underappreciated as well. If you really want to be an asset owner, you do need to have segregated mandates because they put you in control. And just to give you a quick flavor, our segregated mandates are defined by investment management agreements. That phrase isn't going to excite anyone, obviously, but those IMAs are 100 pages long for each of Amundi and Invesco. Bear in mind, the Amundi mandate is passive equities. Still got 100 pages defining exactly how we want them to manage it, how we want them to do stewardship, the reporting we want, all the terms and conditions, liabilities, all that sort of stuff. Whereas if you're in a pooled fund, you've got none of that. You're along for the ride, whatever the manager wants. Can you get these things changed? Maybe, but that's always up to the manager. segregated mandates, we're in total control. We want to change something, we can change it in the IMA, it then becomes a contractual thing. So wanted to put us in control of those mandates, and that also makes it far easier to make changes because you can do in-specie transfers, you can plug in other managers much more easily than if you're having to do pooled fund transitions the whole time, crossing pooled fund bid-ask spreads, right? You get the actual trading costs on the assets if you want to make changes, and so forth. So segregated mandates was a big one. We obviously put 2 new partners in place in terms of Amundi and Invesco. Amundi on the equity side, Invesco on the fixed income side. And on the fixed income side, that is a more actively focused mandate. It's a global fixed income mandate. All sorts of things going on there that I think are quite a bit more sophisticated than how DC typically does fixed income. On the equity side, we use climate indices provided by MSCI. And there we wanted to have a regional kind of sleeve approach. So rather than being in a global index, we've got separate indices for North America, Europe, UK, Japan, Asia, emerging markets. And again, so much of this hopefully is feeding into that, my main sort of thesis around putting the asset owner in control. So we want to be able to control our allocations to North America, to Europe, etc., rather than just be along for the ride in a market index. And I think that is quite fundamentally important. So seg mandates puts us in control. Dedicated regional sleeves puts us in control in equities and fixed income. So before we even get into the actual allocations, hopefully what's clear is that a large part of the work was putting us in control of those things so that we can advise via our investment committee and our trustee to make changes to that in a more flexible way rather than it needing sort of being a set and forget kind of pooled fund type allocation.
You mentioned them there, the trustee, and this is an interesting dynamic that we have in our industry, and it's come up a lot in some of the other podcasts that we've done. That's obviously a lot of change in a couple of years. How has that journey been with the trustee from your perspective?
Yeah, it's a good question. I mean, part of that journey was us becoming regulated and us becoming the appointed advisor to the trustee. So our role, you can think of us as a sort of investment consultant to the trustee, really. That is our formal role and that is our regulatory position. We have a regulated subsidiary that delivers that. So yes, we work advising an IC very similar way in some ways to what I did as a consultant. I do think there's a tighter relationship when you're sort of part of the provider. I think we had to. We were starting from a good place. I think we had a really collaborative investment committee and a really sort of collaborative trustee that had a good appetite for change. I suppose when I started the role, I think there was a bit of a sense that we were at a point where change was appropriate. And so clearly you need that to be able to kind of lean into that kind of change agenda. But then also it's about winning hearts and minds, isn't it? It's about showing some runs on the board, showing that you can deliver change efficiently, showing that you can govern the change and control it in acceptable ways, that you can establish the right frameworks for communicating with the trustee, giving them the right level of info, the right level of reporting. And you've got to go, though we went reasonably quickly, you go bit by bit. And so you sort of prove yourself on an early piece of change. And then you sort of, I think you can win the right to kind of talk about bigger things. And so getting those runs on the board without, pricing errors, without kind of any material kind of issues coming up, I think that gives you, the confidence to sort of go further. The issue you run into, of course, is the more change you do, the more pressure there is on oversighting BAU. So when all your assets are with one provider and they're all passive, the level of oversight is obviously just quite different to when you've got multiple managers and some of it's actively managed. But that comes with the territory. So you've got to find that right balance now between oversighting the BAU piece and delivering change kind of on the front end as well towards that agenda. So you got to get that pace right. I guess that's a judgment that I suppose I have to make as CIO into how much we're trying to go for. But obviously I stay in really close dialogue with our chair of the IC, our trustees, to try and gauge, are we getting this about right? Are you comfortable with this level of change? How much would be too much, sort of thing. So you've really got to work tightly, I think, with your stakeholders to get them comfortable with the change and prove that you can do it effectively.
It's one of my favourite topics, I think, is change, and particularly in that kind of investment philosophy of that. It feels like everything's constantly changing right at the moment. There's so much going on in the economy, but it feels like 2 years ago when we last spoke to various master trusts, it was ever thus, right? And we asked a similar question 2 years ago. So there's always so much going on. And how do you know what is like a seismic structural change that you need to respond to, and how much is just noise? And how do you go about approaching that when you're a CIO? That must be really hard.
Yeah, it is. And I think that's the whole art of the whole thing, really.
Yeah,
right
ultimately.
There. And honestly, I think most of it is noise, to be quite honest with you.
Yeah.
I think a decent starting point is that most of it, or all of it, is noise, to be quite honest.
Yeah.
But it isn't all noise. And telling the difference is the whole thing, really.
Yeah.
So, can't pretend I've always got that right. But some of the things we try and put in place to ensure that we stay fresh is, we have a quarterly investment forum where we get the whole team together and we try and underwrite sort of the whole portfolio from bottom up, each quarter. Now, we aren't looking to make changes every quarter, but I think that process of underwriting it each quarter is really healthy, because on the way into needing to make change, you've rehearsed the conversations, you've had the arguments, you've heard the pushback, you've tested all the ideas, you've looked at all the alternatives. It becomes much easier to do. Whereas I do think stasis is a common problem in investment, in that things just become baked in the way they are, and they become quite hard to change until it's too late. So I think a practice of constantly having that conversation, but with the assumption that the bar for change is pretty high. So we're not looking to make changes. Maybe it's only once a year, maybe less than that sort of thing in terms of how we're positioned, but having the conversation much more frequently than that, so that you establish a good framework for thinking about that. Yeah. Probably, it's probably about as good as I could sort of come up with. But yeah, I mean, there are always reasons to be worried about risk. And history tells you that most of the time, the right thing to do was to not take too much action on the back of that, because equities have been rewarded, probably will still be rewarded. But of course, you need to stay vigilant and not be too, not get too sort of carried away.
Makes sense.
We talk about risk. I mean, how are you and the team thinking about diversification in today's market? We've got equity market driven by small number of stocks. Yeah, we've also got first ventures into private assets. I mean, diversification is a big word and can mean a lot of things to a lot of people. How are you guys seeing it, Peoples?
Yeah, it's a good question. I think that probably is one of the main issues to wrangle with in today's market, is the concentration. Honestly, I'm generally not a massive worrier about concentration risk. I do think that you've got a lot of kind of disgruntled active managers who are constantly moaning about index concentration, to put it bluntly. But you can't deny that it's real. Like the market is being driven by a smaller and smaller number of stocks. I read a research report the other day that said the effective number of stocks driving the S&P is 29. Wow. In other words, the S&P 500 is behaving like a 29 stock portfolio. Yeah. Nothing wrong with a 29 stock portfolio, but usually you would expect quite a lot of conviction to accompany that in terms of those decisions that have gone into it. Whereas obviously the whole point of passive is the opposite of that. You don't need conviction in passive because it's very diversified. Yeah. So it is a really tricky one to grapple with. But as I say, I'm not a massive worrier about concentration. I do generally think that index investing is pretty decent, pretty fine. But yeah, concentration is a real thing. So I think you can take a few steps to address that. The regional sleeves, I think, is definitely one. So we can control, for example, our amount in the US. We can rebalance back to that amount rather than let it ride with the markets. Currency hedging is another one. There's a lot of concentration in the dollar as well. So you've got double concentration, haven't you? There's concentration into the US and the dollar. And then within that, concentration into tech and an AI-driven boom in particular to sort of worry about. So I think controlling your allocation to the US, thinking about dollars is a good starting point. Our main growth fund invests 20% in fixed income as well. So I think that is a bit of a diversifier. And there's been a bit of a debate in DC, hasn't there, whether you should be 100% equities in that growth stage. I think that where fixed income is today, you can get some really great returns in fixed income, and that provides a sort of nice diversifier as well. Yes, like you said, real assets looking to come online as well. There you start to see more of a tend towards kind of how the Aussie super funds are positioned, which often tends to be 50, 20, 30 between equities, real assets and fixed income, which feels a nicer spread than being, say, 100% equities, which I think I can see why people would be worrying a little bit about that in terms of concentration. And the other bit, just round that off, I suppose, is the choice of the indices. So that's a tricky one because you don't want to be chopping and changing your indices all the time. But obviously, we've done climate indices, for example. There's a lot of work out there on custom indices. quite a lot more you can do there now, I think. So, for example, if you wanted to, you can look at indices that cap exposures or that tilt to various quant kind of factors. So there's a little bit of an index construction point there that you can use if you're worrying about concentration as well. The other bits, I suppose, that are not so common in DC are looking at areas such as small mid-cap as an allocation. That's another area you can go to. And then just having more dedicated kind of active management where you might be asking managers to go, in certain areas and get more conviction in a smaller set of stocks, whatever those sort of are. So that's the kind of broad sweep of tools you can use. As I say, some of them we've got, some of them we've put in place recently, some we're still kind of working on in terms of bringing those into the mix.
Well, there's so much to talk about there, and I'm sure we'll get into private markets in a minute, but just one other kind of inverted commas megatrend that we've picked up on is obviously consolidation, and just wondered how that's affecting you and the way you see the world from an investment perspective.
Yeah, I mean, the fragmentation of the UK pensions market has been a big theme my whole career, really, for 22 years. And it probably took me the first decade of my career to even ask the question and kind of be like, hang on a second, why
is it
are we dealing with all these £500 million pound pension schemes?
Yeah.
When you're a consultant, when I started as a consultant, the first time you work on £1 billion pension scheme, you sort of get really excited because it's like, oh, wow, big pension scheme.
Yeah.
And then you realize the proper size, in my view, for a pension scheme is far bigger than that. $1 billion is, in my view, subscale. And so it's been the case my whole career that fragmentation has persisted.
Yeah.
I think it's great that the government is gripping that now in consolidation, but of course, that sounds like a very self-serving statement because, of course, we're one of the bigger ones. So, of course, he would say that, wouldn't he, sort of thing. So I'm not going to sit here and pretend that that's somehow a sort of a neutral statement. But, let me nail my colours to the mast and say I think bigger funds are better. Scale really matters. I've seen the deals we've been able to drive with managers, the things we can do.
Yeah.
At the scale we're at, even the different scale today, we're actually 37 billion today versus 20 when I joined 2 years ago. Even that difference, you see that unlocking the ability to do things that we couldn't back then. So I'm a firm believer that a smaller number of bigger funds is better. Obviously, we're fortunate in that we're above the thresholds today, so it doesn't necessarily need to worry us too much. But of course, it plays into the business strategy over the next few years. It will be for everyone. So it's it's a very exciting time in UK pensions. As I keep saying, UK pensions is having a moment, and I think the consolidation is part of that. And actually, going back to the asset ownership point, a stat I've been fond of rolling out is that if you go back to 2023, the UK only had one asset owner in the largest 100 globally, which was USS. The cutoff for that was about 50 billion sterling.
Okay.
UK has only really had USS that's been like truly in that kind of world-class asset owner league.
Yeah.
Before long, we'll have 5 or 6.
Yes.
Right? We'll be there in probably between 4 and 6 years. Nest are pretty much already there. Look at a couple of the winning LGPS pools that have done really well recently, plus USS. There'll be 5 or 6 up there. And 5 or 6 is, that's Aussie super fund type scope. That's Dutch funds. So the UK will be punching at its weight, I think, sooner than people think in that global sense, partly because of the consolidation push.
And one of the big benefits of the DC market starting to achieve some form of scale is actually opening up new asset classes, and obviously private markets being the big one.
Absolutely.
You mentioned real estate. Firstly, sort of how are you thinking very highest level about private assets and the role they will have for the people's pension going forward? And then more specifically, kind of what you're starting to put in place today?
Yeah, really good question. Obviously, we have thought quite hard about it. High level, we want our private markets to be a kind of growth play, effectively, certainly to start with. So actually, everything I should say here is this is where we're starting.
Sure.
Over time, we'll mature it into a far more matured thing. But one of the challenges of this role is you got to get started somewhere, right? So we're a 37 billion pound scheme, doesn't do any private markets. I talk to all the Aussie super funds, I see their programs, and it's like, I want to do kind of all of that.
Yeah.
But it's one thing at a time, isn't it? You got to walk before you can run, etc. And so you got to start somewhere. So the starting point is it's a growth play. In other words, outperforming global listed equities after fees,
right?
Which is, a steeper target than you might think. I think a lot of private markets funds are not actually set up to outperform listed equities net of fees. And I think, ask some questions about that, because why are you paying the fees? If you can't, I can get listed equities for not very much.
Yeah.
So it's a growth play. We're of a decent scale. We want something that can scale. and something that's reasonably institutionalized as it stands. And so the starting point for us was infrastructure and real estate, because we think they can scale quite effectively. They've been pretty institutionalized. What I mean by that is open-ended structures, much more lower kind of base fees, performance fees, not always part of the equation, but might be sometimes. So it just seems a far more appropriate starting point for us, given we want to deploy in the billions over the next few years. We're very conscious of offering value for money for our members and not wanting to, not wanting to change that. That seems like a good starting point. So we're kind of growth focused, real estate and infrastructure is sort of the brief. And then going back to some of my other points around asset ownership and control, I want to do that as much as we can on a sort of SMA segregated basis, direct ownership of assets.
Right.
Clearly it'd be very easy to run around committing $500 million, 250 million to all sorts of different funds. And then again, you're along for the ride in terms of the manager's geographical focus, the responsible investing approach, everything else. I do want to take a much more controlled approach where we have the control and we have that sort of SMA type arrangement with the manager. And also unlocking co-investments, I think, is a hugely underappreciated in the DC market in terms of how valuable that is.
Yes.
Yeah. That's what lets you drive the fees way down. That means you don't have to put your fees up to members.
Yeah.
But you've got to do quite a lot of work to set yourself up to do that. You need the size, the scale, the relationships, the team, the third parties. So we're trying to do some of that work to set ourselves up right, to use the full suite. Now, and of course, we will invest some money in pooled funds, right? I'm not here trying to say that something terrible about pooled funds. They're a perfectly decent part of the toolkit, but they aren't the whole of the toolkit. So we want to have everything on the table: pooled funds, direct deals, co-invests, and think of it as like a platform, which is how the Aussie super funds think about it, rather than here's a 500 million ticket I'm putting into a closed-ended fund and it's going to come back at me in the next few years and need to be kind of redeployed.
Yes.
The advantage of these kind of segregated accounts or funds of one is you want compounding in the account to work in your favor, right? I've always disliked closed-ended funds a little bit because they don't allow compounding. They chuck the assets back at you and require you to go find somewhere else to put it. A SMA fund of one, the assets can compound within the structure, which is exactly what we want. And if we're targeting a fixed percentage of a growing asset base, it's really working against you to have a closed-ended fund that's giving you the assets back. So I appreciate there are challenges around liquidity and making that work, but I think those are sort of foundational principles of how we want to approach it are important, and they do point you in a subtly different direction than what folks have gone in the past. So we're breaking new ground in some ways. But some of what we're doing is similar to what some large asset owners in the UK have done, and obviously the direction the Aussie super funds have gone. But of course, look, we're chomping at the bit to get real stuff started. Yeah. We'd love to be able to make some announcements, but that's probably next year for a lot of that.
Yeah, you mentioned co-investments and the benefit of that being reduction in kind of the headline fees. Yeah, one of the kind of philosophical debates is around performance fees in DC, and we see differing approaches in the industry from provider to provider. Yeah, have you done much work in this area? Where do you stand currently on this? A
little bit. I mean, obviously, regulation has changed to allow it, and I think given it's allowed, it is probably an attractive thing. I think there's a few things. It needs to be structured. It needs to be structured in a way that works for members, and some performance fees in pooled funds won't be. So again, I think it comes back to having that control. So ideally, it would be a performance fee that's we can help structure, because you want a European waterfall, you want a hurdle, you want it to be accrued in a way that's fair to members, right? Which a lot of if you just turn up as an LP putting money into a fund, they won't be all those things. So you want a bit of control over how it's structured. I think it needs to be in the right places. I'm not convinced about performance fees for core type assets. So I think you want to be identifying areas where there's a more value add component to it. And you obviously want to have a hurdle in there as well. Yeah. But if you've got all those things, I kind of think we probably should like it. It does seem like it could sort of help. Yeah. But there's a bit of work to do to make those things work, actually. That's not a total given. We've never done it before, obviously. So yeah, I don't want to underestimate the amount of work to make those things line up. So you've got to be careful with how we're going about that, I think. I don't want to go out there sort of being like, yeah, performance fees, let's do it. It's kind of, we can pick and choose our battles there. Maybe in certain areas we do the work to make it work for us. But it has to be a structure that works for us and works for the members, rather than simply, your standard pooled fund terms.
Yeah, makes sense.
Dan, I think I'm right in saying you've signed the Mansion House
Accord.
We have.
Yeah, we have. Yeah.
tell us why, and did you have any conversations about that, or was it like an instant yes situation?
There were a lot of conversations around it, some of which I can talk about. We and again, this is public information. We hadn't signed the original Mansion House.
Yeah,
that was obviously 5% focused on private equity. So the expansion of it to real estate and infrastructure was key in our view, really.
Sure.
And hopefully, given everything else I've said, you can see how when that change happened, we kind of thought, well, this is basically what we're intending to do anyway. So in some ways, it became a lot easier because it was like, well, it really just looks like a lot of what we were thinking of doing.
Yeah.
And so that was really at the core of them being able to sign it. We're very big. We're not in the game of launching new defaults to the market with no assets and then having big allocations in them. Mm-hmm. If we do it, it's going to be in our main default. So that is a really big program of deployment that we're looking at, right? So our main default is growing all the time. So most of our assets are in that. So the numbers get pretty big. As I keep saying to the team, you can't focus too much on that. You got to let's focus on the first $500 million of deployment, then sort of work from there.
Yeah.
It has to work for members. So we signed the Mansion House Accord. That's great. Now let's focus on the asset allocation we need, the right rates of return for us, and sort of going from there in terms of partners. Mm-hmm. Another related bit, though, it did sort of chime with my views a little bit on UK allocations. I think in private markets in particular, there is a bit of a stronger argument for having a home bias than in public markets. And it's for a couple of reasons that, again, I think get brushed under the carpet a little bit. Currency hedging. People wave their hands and assume currency hedging is cost-free. It's not, right? You've got to hold cash. You've got to pay someone to do it. You've got to reconcile it. You've got to handle it operationally. Mm-hmm. That's not massive. I'm not trying to make out that it's a huge issue, but it's not nothing. Yeah. It is something. And if assets are domestic assets, you're naturally going to have a smaller, more local team looking at that, whether that's an external manager or internal, whatever, it doesn't matter. That's going to translate to a lower cost of managing those assets. Mm-hmm. So I think those two things taken together, the currency hedging and the lower cost of managing, that should mean in private markets, if you've got an exactly equivalent asset in your home country versus another country, you probably should prefer the home country one. Mm. But that won't always happen. Of course, there'll be some better assets in Europe or other places. What I'm saying is the home assets have a slight advantage, but a real one. Yeah. And that probably translates towards 50% allocation, maybe sounds about right there. Whereas I think in listed markets, there's a far stronger argument around market efficiency and using that as your baseline. And those sort of access costs there are far lower. So they don't really come into it. Whereas, I think in private markets, people underappreciate the currency hedging drag or cost. And also you can definitely drive management fees cheaper on UK-focused strategies because smaller teams, less lawyers involved, they're more local. As compared to sort of European strategies where you've got loads of different sort of jurisdictions there you're dealing with, or the US where you're dealing with teams spread out sort of over a much bigger area.
Mm-hmm. Interesting.
Moving on to another big topic of sustainability.
Yeah.
You've made reference to climate alignment in your index portfolio, the benefit of segregated mandates, giving you power on the way that engagement is done and other sustainability objectives. Where are you in summary on your kind of sustainability journey? And maybe an interesting question is kind of how are you evolving the way you're measuring your progress in the area?
Yeah, that's a good question. So I think there were a few foundational bits we needed to put in place, which kind of a lot of those have been done now. So the starting point for it all was having a really good responsible investment policy that we could then work through and put in place. So we did that just over a year ago. But I think policy is no good unless you can actually put it in place. And I do think you need seg mandates to do that, right? Mm-hmm. I almost think that you can write whatever RI policy you want, but if you're in pooled funds, it's the managers determining that. So the seg mandates was another really key step on the RI journey. So RI policy step 1, seg mandate step 2, and then getting the right aligned partners to deliver that sort of step 3. Mm-hmm. So I've done those 3 things in the last year. So RI policy is done, seg mandates is now done. And on the listed side, obviously getting Amundi and Invesco in place. And one of the things we track is sort of the percentage of the portfolio that is under the direct remit of the RI policy.
Right.
As in it's in mandates that contractually sort of have links to key elements of the RI policy.
Right.
And there's a question over what the right number is. I don't think 100% is ever realistic, because there's always little things you want to do. Like, recently done CLOs, for example, investment trusts, all those sort of things. You're never quite going to get them into a policy. But I think targeting a pretty high proportion of your portfolio being under direct control of the policy via seg mandates is a good target. And we're sort of up there, I think around sort of 70, 75, 80% of the portfolio now is hitting that, which I think is roughly where we'd want to be. There's a few more things coming along. We're doing a bit of change on our emerging market equity piece. I'll be doing that over the next few months, and some other bits there. And obviously, we're constantly reviewing our approach in terms of policy and indices. But those were, I think, the really big foundational bits that were sort of key to get right. Another outworking of that in terms of how we monitor it. Obviously, a key outworking of stewardship is voting, as we've been through a proxy season. So we can now, you've got a great data set on how our shares were being voted in this proxy season compared to our expectations versus, counterfactual prior case. And we can see much more alignment now especially we identify key votes over the course of the season. We can look at how we were being voted versus what we think we would have liked. And that has achieved a far greater level of alignment than what we had prior, basically. So I think that's a good outcome.
What's next on your kind of asset agenda, I guess, when you're looking at climate and sustainability investing? Is there anything you'd really like to get into that you're not currently invested in?
I'm really interested to see how it plays through in real assets. There's a lot of work to do there in terms of what the stance is there, I think. Clearly, real assets, you've got all sorts of exciting renewable energy assets, but that sector isn't without risk, obviously. There's been some really bad underperformance in the US in particular of some renewable energy assets last few years. So it's a sector that has risks like any other. So I think that's interesting. There's clearly a lot of real assets out there that have linkages to fossil fuels. So whether that's something like a toll road, or whether it's a pipeline, or whether it's actually a sort of a primary facility. Yeah. So what our view is on those, I think will be quite interesting to see. But so much of the infrastructure around the world is fossil fuels, right? May or may not be transitioning. So the stance taken there, I think, is going to be pretty interesting. The other bit, talking a little bit about recently, is just what it sort of means for responsible investment, climate in particular, in a world where the policy shift has just not come through in a way that people expected 3-4 years ago that it might do, I think, right? I think we need to be honest about that. I think you have to factor that in the way you're approaching it as an asset owner. You can't ignore it. 3-4 years ago, there was an idea that there would be some pretty progressive policy action. I don't know, say that NDCs might become legally binding, they might be ratcheted up, that industrial transitions would be mandated and regulated. And that hasn't happened in the way that might have been thought. And that just matters for portfolios, because if you're predicating your index construction on that happening, you're going to find your portfolio getting more and more off market. And so that kind of needs to be addressed a little bit. But as part of the reevaluation over the last few years, I think putting responsible investment activities on a firmer footing is quite important as well. I do think it got a bit onto shaky foundations there for a while in terms of slightly conflated objectives and slightly vague kind of wording, slightly sloppy maybe reasoning that was applied. So trying to really get the focus back to financial risk, financial factors, and then stewardship sort of as an additional thing.
Fantastic.
Our industry's been rife with regulation year after year recently, but we've had a pretty big one recently in the pensions bill. Itself, the pensions bill, how's that maybe shaping the way you're thinking about your investment strategy, if at all?
Well, it certainly shapes the way we think about our business strategy, right? And I'm a CIO. I sit on our management team of our business, and that's sort of part of my role, aside from running the investment team. So it is absolutely key to how business strategy is shaping the future of the industry. The fact that there's going to be increasing competition, that choice to the member is probably going to drive more competition. The fact that some of these historical delineations are falling away between kind of auto-enrollment providers and insurers, the sort of direct-to-consumer need. You might have seen our recent brand campaign, really hopefully putting us on the map there as a direct-to-consumer brand for the first time. So a lot of that is obviously interrelated with the pensions bill. And it's all incredibly strategic to a business like us that's trying to plan over a 5-10 year horizon. Obviously, it's really important to recognize what the bill is going to do, and really important to have that sort of stability going forward. But I would say, it's more a kind of a business type thing. On the investing side, that's probably the consolidation is the bigger thing coming out of it. But the other big thing that hopefully will happen and needs to happen is just a better, more transparent kind of approach to assessing value for money and comparing schemes. Now, I think it is pretty ridiculous right now that you can't really compare the costs and performance of two UK master trusts to each other. You can't do that, really. Requires expert knowledge really to do that work, because you have to go and find the right share class, try and figure out what fees, is it gross on net, take the fees off, which fund are you in out of the dozens that a lot of providers have. Very, very unclear. So we need a clear, transparent way that consumers can compare master trusts side by side, like they have in Australia. And I am actually a believer in consumers' ability to make those choices when things are compared side by side. Consumers make high stakes financial decisions all the time, like cars, houses, mortgages, right? Dealing with similar sums of money to pensions there. People make bad choices as well, obviously, but I think in the main, people can be helped to make better choices through the way things are compared side by side. So I often push back on this sense that there needs to be more financial education. It's like, sure, but transparency needs to come first, and the industry is not good at that. We love to each put our own stuff out, shaped our own way with our own gloss on it that skews us in a certain light. And I think the Australian system needs to be faced into far more, to say there needs to be a clear, transparent source that consumers can say, well, that fund did that fund did this. So that I think is something else that can be very big and strategic and important over the next few years. And that obviously intersects with investing as well, because clearly how you're going to be measured, it's got to play on your mind a little bit in terms of how you're investing and how you're allocating.
I'm totally in agreement about transparency and comparability, but I guess the flip side of that in Australia has been herding a little bit, and the way that investors have all kind of gone. We see the problem of straying outside these kind of parameters, and everyone's kind of intersected. Like, I always think of it like that in my head. How do you think we avoid falling into that situation in the UK?
It'll happen. There'll be some of it. It's not the end of the world. I don't know. People see herding as like some inherent terrible disaster. It's not. I mean, if you were all herding into some tiny sector of the UK stock market, of course. But we're talking about herding into global liquid indices, right? In the main, I don't think herding is the big issue people make it out to be. You want a bit of healthy competition in any market, of course you do. And so, yes, there is a fine balance to be had there. The way things have gone in Australia, people are all narrowing towards very similar investment outcomes, but they do seem to be good outcomes. So I don't know that it's a bad thing.
Maybe it's not the end of the world.
So, my view on that would be herding isn't the issue people make it out to be. That can be handled as we go through time. Bit of it's inevitable.
Perfect.
So looking ahead now, what's next on the investment agenda for you? What are you pushing your teams to focus on going forward?
Well, so we're doing some work on emerging market equities at the moment. We're trying to advance our approach there. So that's a big focus of current activity. Hopefully we'll be able to announce something on that probably the next sort of few months. And then we've talked a lot about private markets, real assets, but that's the other big thing.
Right.
So looking in 2026 to be delivering something there, to be making kind of first steps in creating the sort of platform. And we've got a few other milestones to try and sort of get to as I mentioned before, probably got half a dozen big milestones already under our belt. There's kind of similar number of things that I think will kind of complete our current level of kind of asset ownership model. There's a bit of core satellite type things and some of the asset classes to look at. I think being able to use derivatives in a more sophisticated way, things like rebalancing, I think could be really helpful to us as well.
Yes.
So there's a lot of things that I think come up if you start approaching the problem as an asset owner that are different than if you coming from a pooled fund perspective.
Yeah.
And if you had to pick an underrated investment theme or asset class in DC right now, what would it be?
I'm really tempted to say fixed income.
Yeah.
I like what we've done with our fixed income portfolio. I think it's still a bit underappreciated. I think it might get its day in the sun a little bit more as more focus comes on the retirement products, because where fixed income yields are right now, it's a great environment to be creating retirement income products. It really is. You look at our high quality corporate bond portfolio, Some of those are yielding 5.5%, 6%. You're looking at 2% real, 2.5% real easily. Whereas a few years ago, that it was really hard to see how you could make an income portfolio work in the ZIRP world, right? Yields were way down. You were having to take a lot of equity risk to just keep that afloat in real terms. So there's a lot you can do with fixed income. And yes, there's just a lot of levers you can put at your disposal. For example, you can have a global fixed income mandate that looks at US, Europe, UK. You can look at shorter dated versus medium dated ones. You've got sovereigns versus corporates, put in high yield, emerging market debt, securitized. It gives you a really rich set of things you can do. Then I think active management really comes in there a bit more strongly, because there's a lot of sort of obvious issues with fixed income indices that aren't the case for equities. They bias towards the biggest issuers, for example. Can't be quite as intelligent with how they use primary. You've got the downgrade issue. So a real case there for active management being pretty good. And then also a good case for some kind of cross-sector management as well. So switching between, sterling hedged euro credit versus sterling credit is a switch we've looked at recently. So switching on the maturity scale down to shorter dated to medium dated. You've got the kind of sovereigns as kind of a dry powder, and then being able to deploy into other areas. So there's a lot you can do with fixed income. I think the DC world could go a lot further in kind of exploiting that. And I think, hopefully as we bring out retirement products, that might come to the fore a little bit more than it has. Obviously, equities naturally is going to be a huge part of what we do, but fixed income deserves more credit than it's had. Maybe.
A moment in the sun.
Yeah.
Right.
A linked but slightly different question around what's one investment trend or technology that you think will play a role in reshaping DC pensions in the next 5 years?
I'm torn between two answers there, right? So I'm not going to go for the obvious answer around AI because that's already been talked about enough. But I'm torn between quite a mundane answer around kind of technology and systems at the asset owner end, because that is far more complicated and messy than I ever thought possible. But there's some real wins there. But that's not quite so exciting. I think a lot of it is around the direct to member type journeys and the way those are being delivered. Is really important, and that's something that I, as an straight up investment person, really underappreciated. Right, so joining the business, that's been one of my big learnings. In that, let's take a retirement product for example. The investment side of it is actually the easier bit. The harder bit is what member journey do you need to take them on, so that they are sufficiently informed about the product they're buying, but they're not overwhelmed with questions and risk assessments and disclaimers and all that, which is often the way it goes. And that is the whole art of this thing. Millions and millions of auto-enrolled members have got a pension for the first time, which is great. But how can you communicate with them, sort of meet them where they are, to whatever communication thing they want, whether that's emails, web chat, phone, and take them on the right journeys to deliver that. And maybe AI is a part of that, but it's not even as complicated as AI, right? Some of this is kind of like basic web functionality, but it's just being really thoughtful around the journey. And so much of financial services can be super clunky in terms of those journeys, right? You might have these outsourced third-party portals, you're bouncing between different logins, you're getting bounced out of the system because your two-factor authentication didn't come through. You're doing a chat to try and verify your identity, which didn't work because it had an old address in it or something. And that's just to get in the system. And then to navigate sensibly through a series of questions that doesn't involve you putting your marriage certificate, your 3 driving licenses, 10 bank statements and all that in the post, exactly, to get verified. These sort of things, right? So I think that, and maybe I just pick on that because coming from a pure investing perspective, that was a big surprise to me in the role in the business, how important that member journey bit is and how much work there is to do there to create those kind of end-to-end member journeys that make sense to people, as opposed to the kind of balkanized way things often grow up, which is around individual kind of cases. Like someone wants to sign up to a pension, fine, we create a workflow around that. Someone wants to claim their pension, you create a workflow around that. Before you know it, you have 20, 30 different workflows that don't work very well together, even internally. And so that thinking through that, thinking about how members are going to interact with that, some of that can be delivered through apps. Obviously, we released an app probably about a year ago now. It's functionality relatively basic at the moment, but there's a question mark of an interesting question about how much you want to deliver through apps. And maybe I'll leave it with a very philosophical question of should you allow transferring between funds or disinvestment in an app or not? Open question. Might put too much too much sort of ease in people's hands if they, on a Friday night suddenly get all worried about the stock market and want to come out. So
We were just talking about that.
Our industries, the investment industries, had a bit of flack about where's the investment innovation needed for retirement, and I've always thought actually we forget about the retail world as being supporting people through retirement with income generating products for decades. Actually, the real innovation needs to be in how it's delivered in a affluent retirement journey to make it worthwhile.
Yeah, I agree with that.
Fantastic.
Well, Dan, thank you so much. It's been a really interesting conversation. I've learned a lot. So thanks so much for coming in today. And for your
Really
time.
enjoyed the conversation. Thanks so much. Thanks for having me.
Thank you. Thank you for listening to Changing World, New Opportunities, the DCIF podcast.
Visit us online at dcif.co.uk, where you can read all our research, follow us on LinkedIn, and subscribe to the show.